So, Cathie Wood and ARK's funds have crashed. It's not just them though, the Nasdaq has just suffered its worst day since October as part of an overall crash in the stock market. As an investor, moments like this can be scary, but we know that as investors, we need to think long term. As Warren Buffett says, his favourite holding period for an investment is forever. That's why in this video we're going to be looking at the long-term prospects for ARK. We're going to be talking about how to prepare in case there is another crash, and we're going to be listening to Cathie sharing her thoughts on market crashes like these. Just quickly, I am not a financial advisor, nor is this financial advice. Okay, so let's get straight into it, and I won't make you wait. Let's just jump straight into the first clip.
It seems undeniable to me, though, that you must be thinking about the impact of higher rates on the kinds of stocks that have been tried and true winners for you all throughout, whether it's the Signature Fund, the FinTech Innovation Fund, and even other areas of the ETFs that you have. Are you worried that as rates go up, those stocks could come down?
Well, I do believe if rates were to take a sharp turn up, that we would see a valuation reset, and our portfolios would be prime candidates for that valuation reset, of course. Now, one of the things that I've found interesting over the last really 20 years is that the S&P's PE ratio tends to peak out in the 20 to 25 times range of the forward earnings. And I think the reason for that is most portfolio managers and maybe quantitative researchers are looking at normalized nominal GDP growth in the 4 to 5% range, which is where long-term interest rates should be normalized. We actually think normalized GDP growth is probably closer to 3. Now, if you think, and that's where long-term interest rates should stabilize. If you think of 20 to 25 times, that's 1 over 4 to 5% growth. So it's the inverse of the growth rate, the nominal GDP growth. And that's where it seemed to be peaking out. We think there's actually longer term. I agree with you, Scott. There will be a valuation reset. There will be fear, I'm sure, and we will use it to our benefit, concentrating our portfolio to our highest conviction names. But I think longer term, especially given the powerful growth trajectories that the 5 innovation platforms around which we revolve all of our research, that those trajectories are so powerful that these multiples, these companies are going to grow into their multiples a lot faster than most investors are now expecting. And so that's a source of confidence for us.
So there are a few important things we should listen to here. Firstly, Cathie talks about how rising interest rates could lead to a drop in the market. Well, with long-term US interest rates recently hitting their highest value in a year, this is not a hypothetical for the future. This is something we have to consider now. Second, Cathie highlights that the PE ratio for the American stock market usually tops out at around 25, but also hints that it could find a new top of 33 this time. Why 33? Well, because 33 is the inverse of the 3% growth that she talked about in that clip. Now, to give us some context, let's pull up a chart to show us the historic ratio for the market. Now, let's add a line to show where 25 is, and another for 33. So the 25 line is where the market usually tops out. As we can see, whenever our chart has crossed this line in the past, it has usually fallen back below soon after. Today, the PE ratio sits at a very high 38, above both of our lines. And Cathie says this can be seen as an indicator that the stock market today is due a drop. However, Cathie isn't overly concerned about this because she believes that the companies she is invested into will grow into their multiples a lot faster than most people think. But what exactly does that mean? Well, Cathie and ARK invest into disruptive technology. And disruptive technology, it often starts out as promising, but isn't particularly profitable in the early years. And as a result, when you look at metrics like the PE ratio, what you often find is that these companies do appear overvalued. But here's the thing, when technology goes from promising to actually disrupting, that is when the earnings begin to grow very quickly. Therefore, Cathie believes that the companies she is invested into, because they are on the precipice of disruption today, even though they might appear overvalued compared to how much money they're making today, that could all change very quickly as their profits begin to grow rapidly and they catch up with their valuations. Hence, she describes it as growing into their multiples. But how does Cathie know these technologies are about to gain adoption? Well, Cathie uses Wright's law to time her investments. Wright's law says that for every cumulative doubling of units produced, costs will fall by a constant percentage. Or said in terms we can all understand, as we produce more of something, such as equipment to map out our genes, it gets cheaper to produce that equipment. So Cathie's goal is to invest when the technology has dropped to a price where it is on the verge of disruption, and so rapid growth in the coming years is now possible. Having said all of that though, the market has crashed and so have ARK's investments. So the question is, how does Cathie prepare in case there is another crash? If she thinks there is another crash coming, what does she do next?
So my question plays off what Scott just asked you. Do you take into account, or do you have any type of forecast in terms of rates and adjust the portfolio to that forecast? Or do you keep cash there? And ETFs are kind of interesting in terms of the level of cash you're allowed to keep or not keep. So how do you do it? So rates right now, they're moving up. Do you say, okay, we may be in a little trouble here with this valuation reset. They're going to jump up another whatever up to, maybe 2%. Do you get in front of it, or do you just take it as it comes?
No, we use it actually. And so what we've been doing for the last 6 months is expanding the number of names in our portfolio. And we do that as a bull market extends, because in some ways it's a tax efficient strategy. What we will do during a correction, especially a severe correction like the crisis presented, we will sell names in which are creating losses now, because again, we've bought them, we've diversified and bought them more recently. Sell those names, creating losses, to buy our highest conviction names. Some of the names we've been moving into, you'll notice, are names like some of the bigger biotech names, Regeneron, Novartis, Takeda. And what we will do and we think of them as cash-like, but there's also a reason, an investment reason we are moving into them. Ironically, we think they're deep value names because these companies, the ones we are choosing, they are able to use the convergence of technologies that is taking place today in the genomic revolution. So DNA sequencing, artificial intelligence, once again, and gene therapies, new technologies, new ways of doing things. They are investing aggressively now. They have to, because they've lost a lot of their pipelines, or will soon do so. And we think the returns on investment in the biotech space, and I'm talking big biotechs, if they're doing this correctly, could move from the high single digits today back into the golden age of healthcare. So in the 80s, we saw 20 to 30%. So we're using them as cash-like instruments in some way, because we will move back into our pure play names if we get into a severe correction. But we also see the investment merit in these names. They're just not pure play names. So we use corrections toggling back and forth. And so right now, our flagship portfolio has roughly 52 names in it. At the low point last year, it was as low as 33, I believe.
So again, some really interesting points here. As the bull market grows, Cathie diversifies across more and more companies. In the bottom of the market last March, they held just 33 stocks. Today though, they hold as many as 52. And I mean, part of the reason they do this is for the tax benefits. So if the market crashes, they can sell some of these newly purchased shares at a loss, which is going to bring down their tax liability, and it balances out some of the profits they've made. But on top of that, they have begun investing into biotech companies like Regeneron and Novartis, because they see these companies as deep value stocks. So while the stock market has discounted these names, Cathie notes that today, these companies are investing heavily into the important technologies that she focuses on, like gene editing and artificial intelligence. But what's really interesting here is that she describes these companies as cash-like holdings. So in a bull market, Cathie basically believes that these companies can continue growing because they are investing in gene editing and AI. But in a bear market, they almost act like cash because the steady nature of those companies means they aren't likely to crash as much as other stocks. So what do we think of all of this? Well, it's obvious to say, but Cathie has already forgotten more about investing than I will ever know. So I think it's far more honest and more valuable for you if I really just defer to her knowledge on this. All I will personally add is that some people instead choose to cash out of their stocks and they sit on the sidelines with that cash instead of diversifying. For me, I'm not really a fan of that strategy. Did you know, for example, if you invested between 1997 and 2020, you would have made a 334% return if you simply did nothing and held throughout. If you missed just the top 10 days, you still made a profit, but this time it was just 124%. So you lost nearly 2/3 of your potential profit, and that's if you just missed 10 days out of a 23-year window. If you missed the 20 best days, your return dropped to 38%. And if you missed the 30 best days, you actually lost 7%. Okay, so trying to time the market and sitting in cash, it's generally a bad idea. But you probably already know that. So here's something that you might not know. Researchers carried out a study and they found it was more important to correctly forecast the bull markets than to correctly forecast the bear markets. In other words, if you want to try to time the market, knowing when to sell, as some people are doing right now, is much less important than knowing when to buy back in. So if you are going to sell, ask yourself honestly, do you think you can also time the buying back in correctly too? And according to the 2016 Dalbar study, the average person, like you or me, when we try to time the market, we are much worse than the institutional investors, who, by the way, also suck at it. Again, this just backs up the idea that we should not be trying to time the market. As an investor, what we're all trying to do is just ignore our emotions and act as a robot would. Forget how we feel and simply do what makes sense according to the maths, right? Well, I can tell you that the math says that trying to time the market is nearly always a bad idea. The math says that the solution is instead to simply diversify more. That means not cashing out, but spreading your money between more companies, more countries, and more asset classes. And we can see this is exactly what Cathie is doing today. She's gone from 33 stocks to just over 50 in the space of a year. For me personally, I try to go with a mathematical approach if I can, which means diversifying, and then I just try not to look at my portfolio too many times per day. I hope this video helps in these somewhat crazy times.